Good morning. I'm Adriano, the co-founder and president of the European Startup Association. Today I'm with Magnus Eriksson, one of our investors, and he is from Sweden. And please, Magnus, can you introduce yourself?
Okay, thanks a lot, Adriano. My name is Magnus Eriksson, and I'm a general partner of Stoaf. And Stoaf is a Swedish venture finance and competence house that started its first fund in 2008. And after two very successful funds with high return back to the investors and successful follow-on financing rounds and exits in our startups, we started our third fund, Stoaf 3 SciTech, last year. And this fund is still open for external investors until the end of this year. And we will invest in startups during the next 5 years.
Perfect. We met Magnus during our first pitching match in Malmo last year. And then we met him again during our European Startup Festival, same in Malmo. And so we have a lot of experience with him. He was really happy with our startups to give them a lot of tips, a lot of suggestions useful for their businesses. And Magnus, what are some of the key common features of your favorite portfolio companies? Can you tell us about something that you can say to us?
Okay, yes. I would say that our favorite investments, they are, first of all, they're all in line with our investment strategy. And that means that they have a unique technology that gives them a long-term sustainable competitive advantage. And then also, secondly, they have a large global market potential. And they also address the business-to-business market, which we have found leading to more predictable investments. And we do invest in 4 areas. So advanced industrial technology, life sciences, advanced ICT, and sustainable energy technologies. And we also do invest there in very early phases with companies that have an exit opportunity within a 5 to 7 year period. But also very important is that the portfolio companies that are our favorite companies, they can scale, which enables them to generate good profit margins when they reach a reasonable size.
Okay, and last time we met, you told me something about the system that you use for predicting if the business arising from the startup will grow and in the best way it can. So can you tell me just a few things about what kind of system you use for the prediction?
Yes, we have a very sort of thorough methodology for both evaluating, selecting, and supporting your companies. And one of our founders have published a number of books, Best Practice Venture Capital, that you can, actually this one, and we also have another one here written in Swedish that we use. So it's a very transparent methodology. And so how we select, how we take decisions, what criteria we use for evaluating companies, and how we very actively support them being successful.
Perfect. And how many exits did you have?
We have the first fund, they all, that was started in 2008, they are all exited. In the second fund, we had 14 portfolio companies with 3 exits so far, and the other 11 are performing very well. Most of them have gone through follow-on financing rounds with incredibly strong increased valuations.
Oh, lucky.
So it's going very well at the moment. Very well.
Very cool. And we talked about your favorite portfolio companies, but what are some of the most challenging aspects of your least favorite investments, and what can be done to address them to have successful?
Yeah. Well, like you said, we had very few non-performing companies, and because of the very thorough sort of approach that we have, and also the way we support the companies. However, I would say that challenges can be if we have innovations with a large market opportunity, but where the innovation requires large customers to do significant changes in their product design or operating model. And this could delay the market acceleration of the company, as it's depending on the product life cycle of the customer. So that could be one thing we have sometimes seen. And we've also seen that companies where the often then consumer market buying behavior is depending on soft factors and not on the more predictable financial return on investment. And that means that we find many B2 business to consumer startups without technology uniqueness a bit more difficult to accurately predict. And the challenges could also be if we have companies with a product or service that is easily replicated by someone else with more funding. But we very actively support our companies, and one of the things that we work most with is helping the companies with the market entry and keeping high speed in the market acceleration and revenue growth. And we actively support them through a board position. And we may also support companies by finding complementary competencies that I require. And we have a very large network through our investors and business angels in the fund.
Okay. And in your experience, do you think that the business model, B2B or B2C, have different impact on, let's say, the successful of the story of the startup?
Yes, we see that many of the B2C companies can get extremely high company valuations and be, very strong unicorns. However, we also see them being a bit more unpredictable because the success is sometimes or very often depending on more soft factors. What is, how the market perceive them. While the B2B startups, they more sell on financial metrics and client customer return on investment, which we find being more predictable.
Okay. And talking about the investment deals, there are any clauses that you usually include into the shareholders agreement, and why? For example, I don't know, specific governance clauses, obviously tag and drag along and lockup clauses, but there are any of them that you are used to include into the shareholder agreement?
Yes, I would say there is there are many standard clauses that are always or almost always included. And you mentioned sort of the standard tag along, drag along. We have first right of refusal clause, almost opposite. We have governance clauses when we are the lead investor. We sometimes have lock-in or incentive programs for key specialists in the company. It could be minority ownership clauses. Could be right to distribute the ownership to our limited partners of the fund. Rules around election of board members and right to board participation. Can be right to participation in future financing rounds. And then, of course, exit ambitions and exit clauses. But there are many more as well that are usually included.
And are you used to include also KPIs in the shareholder agreement?
We have usually KPIs, something that also depends on what kind of financing model that's we're usually having, different ways of if we have options and those kind of things, and valuation if it is a financing round with a tranche 1 and a tranche 2, could be kind of milestones and those kind of things.
Okay, thank you. Yes, a lot of useful information from you, and I hope that this information could be useful also for our startups. As you know, we will start this year with the scouting of the startups for our investors, and we will profile you as all the other investors more and in a better way than we did yet. And so we will be in touch as soon as possible, and I hope to see you soon.
Looks very good, and we look forward to continuing collaboration.
Of course. Thank you so much.
And okay, thanks a lot then. Thank you.
Bye-bye.
Thanks. Bye-bye.